U.S. equities and bond markets closed for the Martin Luther King Jr. holiday. So futures are trading today through 1 p.m. Eastern time. Right now, some red arrows there. A lot, though, can happen between now and tomorrow morning. Meanwhile, we've got a big week of fourth quarter earnings on deck. So tomorrow, we're going to get Morgan Stanley and Goldman Sachs. We're going to hear from some of the regional banks, PNC, Schwab, Citizens Financial, M&T, and a lot more. That's going to be peppered out through the week. Let's bring in Pacer ETFs Distributors President Sean O'Hara. Sean, so, obviously, especially from an ETF standpoint, it's about the sector. One of the things that we've had, though, with these bank earnings is that they're very, each bank story has been very different, and they're all kind of giving us a different story in each report. So what do you say to the sector right now?
Well, good morning, Cheryl. Thanks for having me. The sector is sort of a diverse sector, if you will. You have some mega banks that have investment banking and asset management services. I suspect they'll do better. And then you've got the regional banks, and we've got this big sort of looming commercial mortgage cloud hanging over our heads. So the thing I think I'd be looking for most in these bank earnings is how much loan loss reserve increase they're going to be setting aside. And that'll give you an indication of who's the most exposed and potentially has the most danger with regard to this big commercial real estate. I think it's going to be a potential crisis. Well,
that's the regionals. That's a good point. I want to bring in Ryan Payne into this because obviously when it comes to exposure to the commercial real estate market, it's the regional banks that are at the most at risk.
And they really are. I mean, I guess the one argument against that is the bigger banks in the bigger cities that hold some of the bigger commercial loans. And they obviously have the balance sheet to withstand that. The regional banks, maybe if you're in a local market, more people go to the office. You have less risk of some of the bigger defaults on the smaller regional bank balance sheets. So I wonder, and we've already seen that priced into the public REIT market where a lot of REITs were down like 70% from peak to trough over the course of the last year or so. So I wonder if some of that is already priced in. And we're at a point now where a lot of the bad news with the banks, which underperformed last year, if anything, surprises should be in the positive, not the negative here, Sean.
Yeah, I'm not necessarily the same page as you. I still think it's about earnings and earnings growth at long term as it relates to stocks. And we just haven't seen any real life, if you will. We've been waiting for financials for, what, a decade now to produce some returns. And you can run the charts on any of the big banks and go back and look 10 years ago. You're basically standing still. And so, given the current environment, I think there's just better sectors to play. Like, for example, we are overweight consumer discretionary. The consumer discretionary stocks have seen massive increases in their free cash flow, and large caps up over 250%, and small caps up over 350%. And this is sort of as a result of them getting things right post-COVID. We had these big inventory overhangs that were really hurting the consumer names. All that's been sort of taken care of, and so you have a much more healthy consumer discretionary sector than you've had, and they've got gobs and gobs of excess free cash flow right now. So I just think there's better places to be than financials given what's going on.
Well, we'll get retail sales this week, so maybe retail sales will give us some more answers on that. Let's talk tech, though. Obviously, last year was about the Magnificent Seven, but it was really about NVIDIA. And look at the stock for this year. A strong start. The stock is still rallying, coming off that 240% rally for 2023. If it couldn't get any better, well, it looks like it is. The S&P 500 is actually looking for record highs right now. So, AI and tech, is that still going to be the driver for 2024?
I think so. I think you need to think about AI in two ways. One is AI helping companies become more efficient. I think the jury's still out on whether or not there's going to be significant impact. I think in the long run there will be. In the short run, what you have to understand is as a part of this digital and technological revolution we're going through, where you have things like AI, but before that you had the cloud and streaming and e-commerce. All of those things eat up massive amounts of data. And so look to where you get the data from. It's mostly from the data centers. And so I think from a real estate perspective, even though it's negative on commercial, I think you can be positive on data centers. And then take a look inside the data centers and pull out those component parts. It's those things that will make AI continue to be able to move as quickly as it has. And so I think there are lots of ways to play AI. We have a particular ETF, the ticker is TRFK, for example, it just owns all the component parts, the software and the hardware names that basically empower and make AI possible.
Good way to ride that wave without, having to do a lot of picking and choosing. ETFs are always great for that. Sean O'Hara, it's good to see you.
Thank you, Cheryl.